What just happened to the stock of Wingstop? The chicken wings chain has been a terrific performer in recent months. Stock rebounding from the low 70s in November to 101 as of yesterday, thanks in part to a strong analyst meeting last month. But this morning, Wingstop reported a confusing quarter that only sent the stock down nearly 3% today. While they delivered a 3-cent earnings miss off of a 17-cent basis, revenue came in better than expected. Same-store sales were phenomenal, up 12.2% year over year. You saw the same thing with the full-year forecast. Wingstop's guiding for 10% plus system-wide unit growth this year. Excellent. But they're also predicting mid-single-digit same-store sales growth, and that seems like a market deceleration. After opening down a couple of bucks, the stock briefly turned positive, climbing to 103. Then it ran out of steam and finished the day in the red, off $2.88. You got to wonder who was right, the buyers or the sellers. The stock's been a big winner for us over the years, so let's check in with Charlie Morrison, the chairman, president, and CEO of Wingstop, learn more about the quarter and where the company's headed. Mr. Morrison, welcome back to Mad Money.
Great to be here, Jim.
All right, Charlie, I'm looking at the fabulous deck and, of course, the numbers. And all I can think of is you have confidence in your model because you have incredible industry-leading margins. And that's what I care about when I'm in the restaurant business. So explain how much better you are than Domino's, Chipotle, Yum, Papa John's, and McDonald's.
Well, Jim, we're a brand that's in a category all by itself. And we do have some of the best margins in the industry, no matter how you compare it. And a lot of it has to do with the strength of our brand and the continued growth. We've just finished our 16th year of positive same-store sales growth. Our core commodity product, chicken wings, has been very stable over the past couple of years. That's good for our brand. Our franchisees are reinvesting now with over 600 restaurants in our domestic pipeline. We continue to see the outlook for growth and the levers that we have in front of us to drive this brand for a long time to come.
In the meantime, I was shocked. 39% digital already? No one's even near that.
No, in fact, we exceeded 40% in the first quarter alone. And if you look at the metrics a little deeper, Jim, you'll see that about 160 of our U.S. restaurants already are over 50% digital and a handful over 60%. So next to the big pizza players, Wingstop's certainly a clear second in that race, but growing fast.
All right, so how's that DoorDash deal working out for you?
Fantastic. We have a great relationship with DoorDash. In that relationship, we've been able to make sure that each of the two companies are benefiting from the strength of Wingstop's format for delivery. We have a high check average. That's great for DoorDash. We generate a lot of tip revenue for their drivers. That's great for the business. And in turn, they deliver a high-quality occasion, very consistent, delivering on the expectations of our guests, which is most important. For us, it's been a big win.
Now, I look at the proven and highly portable brand slide, but I'm stuck by. I mean, you have 10 in Pennsylvania, you have 19 in New York, you have 5 in Oregon. I mean, you could multiply all those by 10 if you had to.
We have a lot of white space, and you hit on the key word there, Jim. It's portability. Our brand has had success in any market that we go to. The key is establishing ourselves in the right areas, the major metro areas. That's our first priority. Fortressing those by having great penetration that creates scale. That advantage leads to consistent restaurant performance. And if you look over time, our restaurants continue to comp up each and every year from the day they open all the way through their history, even our oldest restaurants in the system. So we have a lot of confidence in our ability to really penetrate those markets in the future.
Now, you have a lot, it seems like a lot of information about people. I know you use Salesforce. It seems like whoever owns your stores has really a good sense of who's coming in and what they need.
They do. In fact, we leverage CRM as a key capability to really engage our core guests. We don't rely on loyalty systems, but more importantly, engaging with our guests, understanding what it is that drives their occasion, and continuing to make sure we're taking care of their needs first. And then, you know, as we continue to expand our national advertising format, we're gaining new guests, new people coming into the brand who haven't used our product. That's fueling our same-store sales growth. As we engage with them, that application is ready to go and engage them for future occasions as well, which increases frequency and drives the long-term performance of the company.
All right, you're talking about the possibility of 6,000 stores. This concept obviously travels very well overseas, doesn't it?
It does. In fact, I just got back from Europe looking at restaurants in London as well as in southern France. Our performance has been fantastic out of the gates. We've only been at it a little over a year. We opened our first dark kitchen in London. It's great success. The brand is really resonating and taking off in that market. And in France, people love chicken. It's one of the highest and best chicken consumption markets in the world. we've had a great start so far. So I'm really excited about what our footprint and opportunity are internationally.
I think people have to understand that it's you can't just knock on a door and say, listen, I want to own a Wingstop. I've talked to you before because the restaurant business is hard. You have to earn a Wingstop, don't you?
Well, you have to earn it, and the people who have earned it the most are our existing brand partners, our franchisees. 90% of the restaurants that we open come from our existing franchisees. 80% of our pipeline is from people who already own restaurants and are developing those. It's great to see that our existing franchisees continue to reinvest. It's the easiest way to sell is to sell to an existing customer, as you know. And that's been the way we've done it at Wingstop, and we're going to continue down that road. One
of the things I really like about your model, at a time when it's hard to find labor, and you're really, candidly, you have to get people who haven't had much work experience or have had some experience that wasn't good work. And your labor model is so easy. You're not trying to tell them to do a Beyond Chicken and a drumstick and a wing and a boneless. How did you know to keep it simple?
Well, when you have a brand that's positioned like ours and it's in a category all by itself and you really don't have a true competitor, it's easy to keep your model very consistent and just introduce it to people who don't know it and just keep providing that product that people crave to our existing guests in a high-quality format. Because our restaurants are so small and because nearly 80% of our business is takeout, it's easy to operate and staff these restaurants with very few people, which means we have a lot of great tenure in our restaurants, people who've been around a while, and that, as you know, drives quality.
And then the last thing that I really love about you is that people say, well, I only need to be in A malls. I got to be in an A mall. Not everybody needs to be in a Palace. Your B malls work better than an A mall for you. So therefore, your rents must be pretty good.
Our rents are great, and we are in what other people might refer to as B-, C+ real estate. For Wingstop, that's A+ to us. It's definitely low cost. There's a lot of availability of that real estate. We can expand over the years if we need to. It's been a great strategy for us to hit the markets in the core, work our way out into the suburbs, and then continue into some of the tertiary markets around the U.S. especially. But for us, any site's a great site, and as we continue down our path, we'll be looking for more strategic sites where we can capitalize on delivery, which is a growing part of our business and a big lever we're going to pull this year to be able to even be more stealth, perhaps, in our location strategy.
Well, look, congratulations, Charlie. I mean, you just keep delivering. If I focus on a 3-week period, I missed the gigantic move, and I know better than to do that. Charlie Morrison, the Chairman, President, CEO of Wingstop. Great to see you, sir. Really great to talk to you.
Thank you, Jim.
Guys, this is a long-term winner, and when it's down is when you buy. Mad Money's back in.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.